your forecast for 2021, right? All analysts put out their forecasts in December and January for the upcoming year. You did a phenomenal one on a Real Vision TV that was just published at the end of February, but I know it was recorded in December. And so lots has changed, right? It's been a pretty crazy year, very, very busy. And I'm curious about what may have changed in that you covered, your thoughts on the US dollar, interest rates, inflation, commodities, the emerging markets trade, real estate, gold, Bitcoin, a whole variety of things. We only have about 20 minutes. We won't get into all of it with as much depth. But first of all, everybody should watch that on Real Vision TV. It's excellent. But I want some updates from you today. And so maybe let's start with the US dollar. You had a very bearish outlook in 2020. Obviously that paid off. And now, if I understand correctly, you're pulling back on that a little bit because you're seeing that trade become a bit crowded. Is that correct?
Yeah, pretty much. Starting in late 2020, I started to become less decisive about that, at least in the intermediate term. So I still have a longer term view that we're probably in a more structural dollar bearish cycle. But during that process, you're going to probably have counter rallies along the way. And so whenever it gets too crowded, too consensus, it's easy to have a surprise that pushes it up. And so far, that's what we've seen here in early 2021, still getting used to that, is that we're having somewhat of a rally in the dollar. Now, with the FOMC, press release today, we did get a little bit of a pullback in the dollar due to Powell kind of pushing back, being a little bit dovish. It's possible that can start a reversal, but until we see some kind of major hurdles crossed, I don't really have a ton of conviction in the near term about the direction of the dollar. And so, I'm kind of focusing on other topics of the moment and kind of just waiting until the market gives me more signals on that.
Got it. Yeah. I know you mentioned 3 to 6 months uncertainty. Any hurdles come to mind, Lyn? What would you be looking out for to go one way or the other that'll increase or decrease your conviction?
Well, a couple of things. One is just price levels. We'll see if it starts breaking firmly above, say 92 on the dollar index, and we're seeing some weakness in Europe related to the vaccines, related to their various policies, and because the dollar basket is very euro heavy, that weighs on it, and so that's a pair that I'm a little bit less convicted on. The main thing I'm watching though is yields, and so as we get higher inflation expectations here in the United States, we have other central banks that are kind of taking the turn of being more dovish. And so they are, some of them are doing yield curve control. Some of them are doing kind of indirect yield curve control where they're more explicitly saying that they're not going to let long end rates rise too much. Whereas the Fed has purposely been a little bit, more kind of balanced on that and not really showing at least any concern about the long end of the curve until the market probably forces them to. And that's kind of something we've seen out of this Fed is that they've been very reactive rather than proactive. And so rather than trying to get ahead of things, they wait until the market kind of has a pain point and then tells them what to do. And so they're kind of moving forward with that and saying that they're remaining very dovish on the short end of the curve. They're keeping their QE in place, but they're not really overly concerned about the long end of the curve right now, and that can keep somewhat of a little bit of a floor on the dollar.
Does that concern you, Lyn, that reactive nature versus the proactive planning from the Fed?
Not exactly, because it's all about essentially market manipulation, and so instead of kind of getting ahead and manipulating ahead of time, they're at least kind of letting the market poke around a little bit before they come in and quash it. So I guess it depends on what your view is on that. If you have a certain outlook, you'd rather them just kind of rip the Band-Aid off and do what you want them to do. But if you're kind of just watching market forces play out, in that sense, you want a Fed with a lighter touch. And it's all relative, right? Because they're still holding rates at zero. They're still doing billions and billions of QE per month. And so it's, what exactly is tight versus getting ahead of it it's a relative game. You're basically comparing it to other central banks, and you're comparing it to the massive amount of fiscal spending that's happening and how much of it they're going to have to monetize and how much they're going to have to control rates.
Okay. Last question on the dollar. Just a month ago, I had Peter Schiff and Brent Johnson back on the show, and they were debating, the dollar for 2021. renewing a bet they made in 2020. So they've got a 1 ounce gold coin riding right now on whether the dollar will be higher or lower. I guess it would be like January. It was the final week of January they hosted this. I have to recheck the exact date. But anyways, it was around 92 and it was the fourth week of January. Any prediction? Obviously, Brent's betting the dollar is going to rise. Who's going to take home that gold coin in 2021?
I'd have to lean bearish on that, but again, until we have more signal, that's not one of my higher conviction areas. I was more conviction last year, and I still think longer term we're going to see a dollar weakening cycle. But it's always possible that 2021 ends up being a kind of a neutral year, or mildly up, mildly down. If I had to pick one, I would say probably neutral to down.
Got it. Okay. Now you mentioned higher inflation expectations. You're expecting the Fed to hold rates at zero. Is that correct or not? Yeah. Okay.
Yes. Yeah. And they've indicated them as well, but the market's beginning to test that theory, and they're basically kind of pricing in some rate hikes happening in a year or two. And Powell today pushed back against that, and basically they don't plan to raise rates until they have persistent inflation over 2% as the way they measure it. So people can debate about what is the correct way to measure inflation, but we know that basically what the Fed is using is their model. And so overall, they seem pretty intent on staying dovish for as long as possible. And there's going to be a couple tests along the way. And so one of the big ones to look out for is that in quarter two, specifically April and May, the inflation numbers there, and they'll be reported in May and June. But the reason those are significant is if you look at what CPI did, it took a really big dip back in April and May, because that was kind of the heart of the shutdowns and the big disinflationary period. And so when you do year-over-year comparisons, those are really low base effects. And so there's a decent chance we're going to get a CPI print that's over 3% in April or May. Probably both. And so, but Powell already referred to that. He also already said they're going to call that transient. And so you might have a mismatch between what the bond market's doing and what the Fed's looking at. And so, we'll see if things get a little bit disorderly around that time. But the Fed's already aware of that, talking about that. And so it's something that's kind of the next time period that I'm monitoring.
Okay. Thanks for that. Now, just to touch on that. So, we're expecting inflation to run hot. We're expecting the Fed to continue to suppress rates, creating this, negative real rate scenario, which is typically a great setup for gold. If that's the consensus, are you surprised that gold hasn't performed better since August? It's been a very soft market.
Not really. It's been, I guess, slightly weaker than I would have expected, but overall, it's pretty much doing what I'd expect from the 10-year doing what it's doing. And so a lot of people focus on the shorter end of the curve, but because gold is generally a longer duration asset, it's best to compare it to other long duration assets, such as the 10-year Treasury or longer. And so if you look at the real rate in the 10-year, ever since August of 2020, we've had nominal rates rising faster than inflation expectations. And so you've had a rising of real yields that are still negative, but less negative than they were at their bottom in August 2020. And so even though if you look at, say, earlier in the curve, like the 5-year, you're getting kind of a wider, kind of a more negative rates. If you look further out at the 10-year, that's where you're kind of getting some solidity there. Now, I do think that as we go forward a little bit, we'll get, inflation expectations probably catching up to that. And we might have seen kind of a rollover where gold kind of finds a bottom, real rates find a top. We have to see a little bit, more conviction on that. Right now, it's kind of a potential turning point that I'm kind of monitoring, that we might see a little bit of a decoupling here, and gold kind of find its legs a little bit. But kind of the ultimate long-term thing is the potential for yield curve control or things like that. But the Fed's unlikely to move on that until things get disorderly enough that the market's essentially demanding it. Until then, they're basically keeping the short end tight. They're letting the long end rise. And so gold's kind of in a mixed condition because the gold really kind of focuses more on that long end.
Got it. Okay. Now I have to ask, because it's a common conversation these days, specifically from gold bugs more so, that Bitcoin is eating gold's lunch right now, right? As the asset, the role that gold used to play, a lot of that dough is now moving towards Bitcoin. Do you have any thoughts on that, Lyn? Does that resonate with you, or do you think that's missing the point?
I think around the margins, it stole a little bit of the narrative. But if you look at, if I just looked at what gold, if Bitcoin didn't exist, and I'm just looking at what gold is doing compared to 10-year yields, nothing stands out as unusual. Now, it might be on the weaker side slightly of what I'd expect. Maybe it's $100 lower than I think it should be. But overall, it's roughly following what I would expect from money supply growth and from those 10-year real yields. And so, it's possible that Bitcoin is responsible for the fact that it's on the weaker side of what I'd expect rather than, say on the stronger side or kind of average. But overall, it's not really doing anything enough that I would call it deviant from how I'd expect gold to be behaving in this 10-year environment. Now, overall, real yields rose a little bit quicker than I would have guessed, say 6 months ago, and so gold's been slightly weaker than I would have guessed 6 months ago. But comparing those two measures together, it's making sense as gold relative to real yields. But because we're getting such strong action in Bitcoin, and because younger investors are generally using Bitcoin more like that gold proxy, we are probably getting some money flows that would have otherwise gone into gold and silver instead directed towards Bitcoin. But I view it as a big mix. And so some people are only one camp, only the other camp, whereas I like Bitcoin, I like gold, I like silver, I like copper, I like uranium, and I kind of just tilt them based on what's getting out of hand. And so, for example, last summer, I was still bullish on gold, but I started rotating more and more into some copper, some Bitcoin, things like that are a little bit more of that kind of kind of inflationary bent to them, and those have done well. But for example, copper, I think is it's gone up pretty fast, and so it's starting to look a little bit more interesting towards gold again.